We are talking this afternoon about resource efficiency with a very bold statement. Resource efficiency equals shareholder value. A question, give it as a statement, I want to use this as a question. Does it? Do investors realize it, even if it does? And how can we make sure that even it's truer in the future? We have an eminent panel. Starting off with Jean-Marc Huet, who is the CFO at Unilever, who will kick off our session shortly. Andy Wales, who's the Senior Vice President for Sustainable Development at SAB Miller. The brewer, Caio Koch-Weser, who's Vice Chairman of Deutsche Bank. And Paul Donovan, Global Economist at USB Investment Bank. Wrong way around. Sorry, the other way around. These two guys look quite similar, if you've got eyesight like mine. Now, I'm going to ask Jean-Marc Huet to kick us off with a short introduction. I'll then bring in the other panelists for some short contributions of their own. I've got a few questions which I'm dying to ask them, and as chair, I'm going to allow myself to do that. But you've also got your little iPods in which you are encouraged to email me your questions, either ones that you'd like me to ask you if you're very shy and retiring, or if you put them in the other column, things that I will then call you up for. I gather that I see that in previous sessions people have just raised their hands, which is obviously a very low-tech way of calling questions from the audience, but I'm happy to do that as well. We have about an hour, although the timekeeping there says a little bit less. Jean-Marc Huet is going to kick us off. Jean-Marc.
Great, thank you very much. And I'll try and be short, given the numbers over there, and I'll try and also not be depressing. Let me just make a couple of very brief points. I also won't talk too much about Unilever. But in essence, who we are is threefold. We are a branded business for those who either love or hate Marmite. For those who get excited about Ben & Jerry's and ice cream, please eat as much ice cream because the weather really does drive the performance in that part of the business. But also Omo, laundry, personal care, Dove, and the like. So we are a fast mover, consuming good branded business. We are also a people business. We have 180,000 employees, and that's just the employees with our badges. It's probably 3 times the amount if you start to look from a broader value chain perspective, and all these people have families. And thirdly, we're quite big. We've been around for 125 years or so. We have 45 billion of revenues, and we're in 180 countries. So that's enough of who Unilever is, but it is important because when we're speaking about resource efficiency and shareholder value, there are a couple of comments that I would like to make. The first thing is, what we would like to do is actually quite simple, but it's very, very difficult. We want to double our business and reduce our environmental footprint over a period, say, of around 10 years. So just imagine creating a new company, the existing size of Unilever, but without an environmental footprint. And if anybody asks the question, how are you going to do that? I do not have the answers. But that is what we have set ourselves to do. Bold, ambitious, and hopefully over time, increasingly realistic. Now, why do I think that this makes business sense and as a result, good shareholder value? If you take our business model, it's essentially all around the Unilever Sustainable Living Plan. That, in essence, is our business plan. It impacts growth, cost, reinvestment, and just like John said at Coca-Cola, it drives everything that we do within the organization. But to be more specific, it inspires our employees, and specifically the younger generations. I'm amazed, I feel old when I sit down with 20, 25-year-olds. It's not about pay, it's not about compensation. Yes, it's about career, but it's all about what is our role towards sustainability, and within that, resource efficiency. 90% of our total employees understand what we're trying to do. 89% are proud of growing sustainably. I think that many companies underestimate that if they are indeed a people's business, and that's not just specifically for fast mover consuming goods. I think every industry ultimately is a people business. The second one is I'll come back to the point of brands. It is only anecdotal. Again, for investors and journalists out there, it's anecdotal, but we are starting to see that brands that incorporate resource efficiency, take as an example hair shampoo without water, toothpaste without water are gaining traction. They are growing. I'm not going to compare it with other brands and the like, but we're starting to see that consumers do get it. They may not pay a premium between two products, but if it was at parity, absolutely they would understand it. And anecdotes are also telling us that they will start to pay for this. It's generating savings. If we look at eco-efficiency savings, you've been thrown so many numbers. I'm not going to give you the ones about Unilever, but we love savings. And I'm a finance chap. I reinvest most of those back behind our brands. That's the business that we're in, and give some to the margin, which investors like. The other reason why sustainability and specifically resource efficiency is so important, it drives sustainable sourcing, and we are seeing change in terms of palm oil, in terms of how sustainable sourcing is taking place. Equally importantly, not only with suppliers, but with customers, it's making business sense. When we sit down with Tesco's here or Walmart in the US, they are equally interested on what we're doing. So there are people outside our specific value chain that care. Again, I want to just take the discussion away from the global, from the macro, but to the fact that it really does potentially create shareholder value, and it's up to us to demonstrate that. One statistic, 65% of our suppliers believe that sustainability and resource efficiency will give a good return on investment. Next point, reputation is absolutely everything. And we're believing, and we really drive with Paul Polman, our chief executive, a huge amount of time driving our reputation with stakeholders. Obviously, it has to be backed with substance. Obviously, it has to be backed with numbers. We can't just talk. We have to walk the walk. But the point is, it's becoming so important to our reputation. For those finance people, if you look at a balance sheet, reputation is the most important part to our balance sheet. Now the point of just risk management. As a finance person, as the chief financial officer, I do not like to give caveats to performance. But if you look over the last 2 to 3 years, it is impressive, and I'm very happy that we're in 180 countries, the amount of impact on our global business. New Zealand, Australia, Japan, earthquakes, flooding, North Africa, political instability, it's something that we've never seen over the last 30 to 40 years. And so to be able to deal with these supply shocks, not everybody is global, not everybody is in 180 countries, you need to be resource efficient. Let me continue quickly. What are some of the challenges that we see? The first one is you need to embed resource efficiency and sustainability in everything that you do. I cannot pretend that all 180,000 employees do. It can be in terms of budgeting, forecasting, I have to go quicker, monitoring and the like, but this is very important. The second one is look at the totality of your value chain. In actual fact, it's the consumer behavior that needs to change. How long did it take each and every one of you to figure out that there are 2 buttons on your loo? It took you a while. Next point, we need to convince our investors. Again, very simply, most stocks are based on how much cash the company creates. If you look at the present value over 10 years, you then look at the terminal value, could be between 40 to 60% of the value. If you're going to be long-term and sustainability is critical, you have to attach that into your valuation methodology. A.T. Kearney, a consultant, told us earnings could be down up to 47% by 2018 for FMCG companies that do not have strategies to mitigate risk posed by environmental pressures. Now, if that's a risk or an opportunity, I leave it to you, but it's fundamental. So how can it be that resource efficiency does not equate to shareholder value? That's it.
Jean-Marc, I wanted to ask you something about this. This is a very positive story. As you say, Unilever has talked a lot about this. Do your investors understand it? You've made an interesting decision recently not to report quarterly. Is this because you think your investors don't really understand your strategy, that quarterly reporting is in some way acting against this long-term strategy? Do your investors get this?
I think the short answer is, and again, under time constraint, is no. at the end of the day, it has to be about business performance and sine qua non. I cannot sit here and talk about sustainability and resource efficiency if the backdrop is not good business performance, because that, at the end of the day, is our right to be at the table. And the investor is primarily focused on our business performance. They are starting to passively get it. And the way I see it is that it's up to us to actually just speak more about both points, business performance and sustainability, and one day they will.
Let me come to Caio Koch-Weser of Deutsche Bank. Is it your experience, your understanding of the market that shareholder value does equate to resource efficiency?
Well, let me first preface that and the answer to this question by some observation building on this morning. I think we have to conclude, and I'm quite pessimistic here, that governments and the UN international multilateral framework will be failing us. We will not get the carbon price, we will not get the energy subsidy reductions, we will not get proper pricing of externalities in the near future. So the incentives remain very problematic. And I think what is worse, and Rio has shown that, and I'm afraid Qatar will show that the short-term crisis of sovereign debt and financial markets stands in the way of dealing more thoughtfully in policy circles with the longer-term crisis that we all are concerned about. So I would conclude, and also from the many things were said this morning, that leadership has to come really from alliances of like-minded enterprises much more on these issues. I think many boardrooms, very many boardrooms, are far ahead of cabinet rooms these days on these issues. Now, what beyond our usual business do these alliances where we join hands of like-minded enterprises providing leadership, what should they do? I think, number one, that we need badly, jointly, develop in a very concrete sense, strategically, the narrative of and roadmap of what I call, for lack of a better word, green economy. I really see the resource efficiency, the renewable agenda, the resource efficiency agenda in a broad sense as drivers of future growth with the big technology leaps, in a way contributing in a decade that lies ahead of very subdued potential growth, short, very volatile business cycles, the new normal in a sense, of providing the growth that IT in recent decades provided after the Americans decided to put a man on the moon. Now, I think to engage in that strategic narrative jointly and convince others is one. Second, we have to change the dynamics of interaction with policymakers. So often in the past, we waited for the policy framework, for the policy action, and then we filled this out with our business. I think this has changed. This has to change. We will have to come with the concepts, with the ideas, with the analysis, and then engage, pressure the policymakers to come around. So we reverse the dynamics of business-government interaction. And the way we do that, third, is that we develop some of the truly transformational technologies, ideas, concepts, projects. I think what we are doing with many technology companies, with utilities on desert tech, bringing solar power from the Sahara to Europe as a long-term vision, where we then went to, for feed-in tariffs, to the commissioner in Brussels, to the German government, is one example. There are many others. I think you also engaged in the supply chain, decarbonized supply chain. So the dynamics can be different, but the transformational ideas have to come from us. Now to your question, how do we convince investors and shareholders in that? And let me simply share with you the results of a very comprehensive study Deutsche Bank Research has done recently on whether it pays to incorporate sustainability and broader ESG, environmental social governance dimension into business and investor models. This research examined 100 academic studies, independent academic studies, and found, number one, that 100% of these studies conclude that companies incorporating ESG factors into their business model create lower cost of capital. The markets begin to recognize that such companies are lower risk. 89% second of these studies found companies had better market performance. And third, investors who focus funds on companies with the best-in-class ESG performance can capture superior risk-adjusted returns. I think this is fairly robust research. It's very important for company boards and investors. In other words, business models incorporating leadership and sustainability and ESG will do better. In Rio, there were very interesting discussions what could follow from that. For example, the whole drive for integrating financial and ESG reporting. 5 stock exchanges in Rio, led by Nasdaq and others, will now, for all their listed companies, require, or at least strongly encourage, integration of financial and ESG reporting. I think as a point of departure, I think this is good evidence, very recent evidence, carefully done, on it begins to pay to provide sustainability in your business model.
Thank you. I wanted to ask Andy Wales then from SAB Miller. You are Senior Vice President for Sustainable Development, so we can be pretty sure that what you do is about sustainable development. How much of what your board looks at is about sustainable development in your company? It's a heavy resource user, drinks company. Is this something that you do, or is this something your board is interested in?
It's certainly something the board is interested in, and it's clearly something I coordinate in the business, but increasingly it's something that is integrated into each of the core functions, both globally and locally. And that's because SAB Miller is a business that grew from Africa, is now operating in 70 countries directly or through joint ventures. And actually about 70% of our income comes from emerging markets. And perhaps a bit different from Unilever, our work in this area isn't driven by, first and foremost, by a compelling sustainability vision. It's driven by a vision around being the most admired brewer with that emerging market growth profile. And so, as a business that wants to grow in countries that see resource scarcity becoming reality now, and even more so in the coming years, that's quite a critical part of running your business well and growing your business well. And one thing in that context that is important that we all say is, and particularly from what we heard this morning from Hans Rosling around the growing middle class in different parts of the world, is to first and foremost celebrate the fact that those additional 3 billion people coming into the middle class will have a higher quality of life and be able to do some of the things that you and I can do every day. Have a coffee, have a beer at the end of the day, occasionally perhaps eat meat. And one of the things that even consumer products companies like mine don't do enough of is celebrate that growth in kind of quality of life in the emerging world. And when we were at Rio, I think one of the stumbling blocks, not just from government, but also from business, was when we were engaging with G77, some of the developing country leaders, was that we didn't start talking about jobs and growth and opportunity before we then explained the resource efficiency gains we need to get there. Because resource efficiency does underpin us being able to deliver that business growth for the future, which is why the board is so interested in it. I think in the short term, there are quite important efficiency gains that can be made within fast-moving consumer goods businesses, food and beverage businesses, as well as our value chains. And sometimes in the policy and academic space, I think they are overlooked. Because the difficult academic thinking on resource scarcities and efficiency has been done. I mean, Henry Lovins did Factor 4 many years ago. But actually, the implementation and execution of that through big businesses and their value chains is only just happening now, I would argue, properly. And there's a big opportunity there. So our targets, for example, by 2015, we want to become 25% more water efficient. By 2020, 50% more carbon efficient. Just as Unilever, the outcome perhaps is the same. That will essentially mean that we can, up to 2020, perhaps double our volume in different parts of the world, particularly Asia Pacific and Africa, whilst having the same environmental impact. But my final point is that some resources like carbon are global, some resources like water are local. And so it's not enough to just be efficient around a resource like water, because that might reduce your cost base somewhat, but it won't necessarily remove your risk. Often the debate around water is actually an access debate, and it can be quite nuanced in different places. And that's where one of the challenges for business is to change the skill set or add a skill set to be involved in the beyond the fence line policy conversations about, which sometimes take a long time and take a lot of patience, about how you manage water supply, say for a city like Dar es Salaam, where we brew and is very water challenged. And to be able to grow there, we need to be an active part of that water conversation, rather than just putting in capex like reverse osmosis to help ourselves in the short term. And that's where we work in quite innovative models, I think, with WWF, with GIZ, part of the German government, with others, to start to get engaged in thinking about how do we secure water supplies for our business as part of our operating model, not as part of philanthropy, as well as ensuring that surrounding local communities and ecology get their needs met and are protected. And it's only by doing both the efficiency piece, which has some financial gains, and then the access piece and the shared resource piece that will secure the future growth that shareholders and the board want.
Can I ask you, the environment actually doesn't care about resource efficiency. It's the total demand on the world's resources that matter, and how efficient humankind is or companies are in producing their value is irrelevant. It's the total demand that matters. So you can improve your efficiency by 20% or whatever over a period. Is your total demand, environmental demand, that is the resources you're taking out of the environment, the wastes and so on, declining absolutely? Or so is effectively your company growth overcoming the efficiency gains that you're making?
No. So what we're seeing in the medium term, we will see in the long term, is that the emerging market growth, which is the thing that's driving the challenge we're discussing today, will not lead to additional resource use, because at different paces on different resources, it will be contained by efficiency gains. But in some places, the efficiency gain won't be enough because there'll be particular pinch points.
So in some cases, your growth is exceeded by your efficiency gain, and some not.
Yeah, but also, I mean, for example, there are places like Rajasthan in India. We have a brewery there in a place called Rochis, where we have a whole recharge scheme which recharges more water to the aquifer than we use every year in that brewery, because it's a dry area, it's a desert area. That doesn't remove the risk to our business of being cut off from that water supply, because the thing that drives water scarcity there is small farmers continually extracting water for their crops, linked to the fact that electricity is cheap and intermittent, so they leave their pumps on, and when electricity comes, they pump for flood irrigation. So what we need to do there is work, in addition to doing these, recharging the water that we're using, is also work with small farmers to tackle the bigger regional problem around their kind of wasteful use of water due to certain system conditions. And that's what will give our business security there, as well as the efficiency stuff.
Okay. Turning to Paul Donovan from UBS Investment Bank. You're an economist. Is it your view, your analysis, that resource efficiency equals shareholder value?
It's the wrong question. And the answer to the question is I don't care. I really don't care about shareholder value as an environmental economist, because shareholder value is not the key issue here. UBS, like all investment banks, employs a large number of equity analysts. And our equity analysts like to think that they're important. Equity analysts are not important. Economists are important. Equity analysts are parasites who feed off of economic research. Equity analysts look at 40% of developed country private sector GDP. They look at 30% of private sector resource use. 70% of private sector resource use, 60% of private sector GDP is the small and medium-sized business space. That's what we've got to get right. That's where we need the resource efficiency to come in, because they are inefficient now. That's why they're using 70% of resources to produce 60% of private sector GDP. Now, here's the problem. We've just gone through, in my view, the biggest structural change in the global economy in the last 5 years with the global financial crisis. It's the biggest structural change that we have seen at least since 1971-73. And what we have got coming out of that is a global shortage of capital, a global war for capital. We've got capital controls, soft capital controls admittedly, but capital controls being imposed across the board. The British government's put in place capital controls. Bank lending outside the UK, not allowed. You've got to lend to the UK. Well, that sounds great, but it's creating inefficiencies. It's creating shortages of capital where we need them. It's raising the cost of capital. And so the challenge for the small and medium-sized business sector, which is struggling to get capital at the best of times, is that they can't achieve resource efficiency through investing, they can't achieve resource efficiency through upgrading technology, and frankly, they're not going to be able to do so for a decade. The hope, I think, is that we target the resource efficiency appropriately, and we encourage the reduction of waste. Do what you're doing now, but just don't throw away so much is one possible solution. Long term, yes, we need to upgrade the technology. It's just not going to happen in the near term. Secondly, I think that the business sector has got to understand that it's not just them that's got to become more resource efficient. They have to realize that in the aftermath of the global financial crisis, consumers are also very opposed to waste. And so as a result, I think they've got to tailor their business models to deal with a consumer sector that itself is trying to throw away less. And there's evidence of this. Food is one of the very obvious areas. Energy is another area where you're starting to get that come through. But I think that to focus on shareholder value and big companies is going to be a very inefficient way of improving efficiency.
Thank you. I want to pick up this, this question that I asked you, Jean-Marc, about whether the financial community understands this. So let's, and this would be the financial community that is lending to or investing in smaller businesses as well as equities of major companies. Caio, your research that you quoted from Deutsche Bank seems to suggest that resource efficiency does equate, or at least resource efficiency and the wider group of environmental, social and governance standards, the ESG performance, does equate to shareholder value. Those companies that do that outperform the average. But Jean-Marc answered that his own investors, this is a company that has majored on this, they could hardly be unaware of your commitment to this, since you've told the rest of the world quite a lot about it, don't understand it. How do we get them to understand it? How do we get financial analysts, if it is indeed true that it does equate to shareholder value, that there are additional profit, but how do we get them to do that, Jean-Marc?
Well, I was just going to make the comment. Firstly, UBS and Deutsche are brokers of ours, so I'll tell the message to your equity analyst, respecting your Chinese walls.
Please do.
Come to us.
Yeah, and I'll come to yours in a second. It's a very difficult point. You know, just the evidence that we have a market cap of 100 billion. Fortunately, unfortunately, we go on investor roadshows each and every quarter throughout the world, and there are next to nobody that asks any question about resource efficiency and sustainability. I put, as well as Paul, undue pressure on our investor relations department to try and find those fund managers that are interested. And we come across all kinds of issues. Some of them are organizational, the back office not talking to the front office, so those who are interested aren't the ones who are buying or selling. Secondly, there are some that haven't put their hand up, and please, if there's anybody who is interested in this topic and is investing and funding, please come to me after this, because we are absolutely looking for people who get it. But as it stands today, we probably share investors with all the other companies of corporates in this place right now, and the evidence is that nobody's asking about it. So I just wanted to just give you that. That's what the investor is just telling us. But that is slightly different to the point you're making, which is about shareholder value itself. But maybe you want to comment on that.
I think the answer to this is really integrating financial and ESG reporting to make people much more aware, to make this part of the analysis. I think if you make that mandatory, that would be a huge step forward. Including stock exchange, I talked about this pilot initiative.
It should be mandatory. So the kind of reporting that would actually reveal this, that you don't need to do a special report of 100
I don't know what you feel about it. But
no, I think that a lot of people are currently talking about integrated reporting. Right now, I'm more focused on the issues from an IT systems perspective, to be able to demonstrate that the numbers are the numbers. It is not an easy thing.
Not easy, yeah.
But again, our mindset is we need to double our business, reduce our environmental footprint, so we need to be bold. But I absolutely agree that ultimately, integrated reporting and actually having our sustainable living plan as part of our annual report, so to speak, and the way we are measured is on financial as well as non-financial measures, that has to be the way forward. One day we should not be getting a profit warning, but a resource efficiency warning, so to speak. Integrated reporting will be one of different ways to get there.
Andy, did you want to come in on this?
Two things. One is that, I mean, we do report our key sustainability KPIs right at the front of our annual report, just like our other KPIs, but clearly it has to be a very select group of the material ones that investors are interested in. Second, I mean, we do get some questions from investors, but they're relatively limited and they're quite specific to certain markets, and it's as they build their valuation models for the long term. And I think one of the things, just like the resource efficiency stuff, it's been talked about for a long time and is just now being really seriously implemented at scale through big businesses anyway. The kind of valuation of companies based on this is also now emerging. So there's huge amounts of work going on in all sorts of investment houses to understand, what water risk means for the different FMCG companies. But it involves quite a lot of watershed by watershed risk analysis. It involves things like the Water Disclosure Project, part of the Carbon Disclosure Project. It's going to take some time to get to maturity. We need to catalyze that and accelerate it, but I think that journey has started.
Okay. Jean-Marc, I want to come back, because a question's been asked from the audience, which is a rather good one, which is that you say that investors don't understand this properly. Does your own pension fund? So is your own pension fund at Unilever, which is a very significant institution in itself, interested in this? Is it looking at this?
So, frankly, not enough, but it's absolutely one of the objectives that we're discussing with our pension fund is to play a role model. So the answer is not enough, but it's an area where we can probably apply more pressure than in other areas.
I want to come a little bit later. I want to ask people from the audience who are in the financial community to, if you have any experience of this, as raising this, of being interested in this, of using metrics on this, to come back. Is that, were you going to answer that specifically? Can we have the gentleman here?
Yes, I'm George Latham at Web Asset Management. I totally agree with the point that's made that investors don't ask enough about these questions in shareholder meetings, but I think that leadership has to come from both directions, and that some of the companies that do lead in this agenda don't make enough of it in their own presentations to lead the conversation with investors. Marks and Spencer make, I think, 10 to 15% of their annual pre-tax profits now from costs avoided by their Plan A. They never put that in their investor presentation, at their annual results presentation. So I think the leadership has to come from both directions.
Maybe it's a slight digression, but I think I'll come back to your point that what really matters is what happens to the small and medium-scale enterprises. And that's not shareholder value, but that's how you finance, how you de-risk the investment. Coming from Germany, where a lot of this innovation, also in the renewable area, comes actually from smaller companies, family companies. It's very important. And here I think our experience in running with KfW, with EIB, a number of these big energy efficiency funds, where you de-risk the waterfall structure, first loss guarantees and others, with limited amounts of public money, much larger investments, you leverage up much larger investment flows, addresses exactly those issues and connects you to this whole class of businesses. I found it very interesting, again in Rio and in Los Cabos, that the big development banks, because you need public money and finance ministers have empty pockets, but the huge balance sheets of the national development banks, which are public institutions, and they form this club of 19, International Finance Club, with the aim of financing, particularly of promoting the financing of green infrastructure, is very significant, because here you have among the 19 more than 2 trillion balance sheet, and would exactly meet also what we put forward in the high-level advisory group on climate finance, Secretary General, this leveraging up with limited amounts of money. Our experience with these funds, in fact, even with IFC in China, is very promising in what you trigger. That's just, it's a slightly different point, but to get back to this, because they're absolutely key. If you don't get at these set of companies, we are not getting there.
I was going to say one thing on the issue about integrated reporting. There is a risk here, which I think we need to be sensitive to, which is if you start having, okay, we're going to report our targets for this, it's what we call in economics Goodhart's law. As soon as you create something as a target, it becomes irrelevant, because everybody always meets their targets. It's like China. You always meet the target. And then you miss out on some of the other things. And one of the things, and Jean-Marc was mentioning this in his presentation earlier on, one of the things I think is very important from an economic perspective and what comes down to shareholder value, at the end of the day, most companies, 70% of their cost base is labor. So if you are creating an environment through whatever means that supports labor and the younger generation are focused on resource efficiency or focused on environmental issues, you then create a more cost-effective company through your main cost. But that's something that's very difficult to put into an integrated report. And if you're focusing all of your energy on, we're offsetting all of our carbon footprint by planting trees, wonderful though that is, you're perhaps missing the main point of what you should be concentrating on and what will eventually help your bottom line and at the same time make you a more efficient company.
I just wanted to make one addition, which is I think that a way to impress the importance for investors going forward, given the limited success that we've had now, is to demonstrate how sustainability, resource efficiency actually drives growth rather than cost effectiveness. And I think that if we are able to show, be it waterless jeans, be it different ways of putting shoes together and the like, that are not only cost effective, but you're actually driving growth too, it'll be a much easier conversation with investors. By the way, I agree totally with your point. It's really up to us to also drive the topic. What I see with your friends, the equity analysts, is they always react to whatever we have to say. So your point's absolutely spot on.
Somebody has asked here, however, this is not only about reporting by the corporates, it could also be about reporting by investors. So, for example, given that you've done the research, Caio, at Deutsche Bank, does this now get included in your own notes about companies and investors and so on? Is this something that actually the investors should be noting in their reports on companies?
It's very much a work in progress. I would not say we are there, but I think, frankly, my view is also, after all that happened, a way to reconnect to stakeholders for the financial services industry is exactly this whole area of sustainability and integrating ESG in our work in a much more explicit way. We do this in our funds we run. We pick the ESG best-in-class approach for our specific equity bond funds. We have a number of climate change-focused funds where this plays a role. We are training, of course, our people in that. We have a fairly strong team across the board now in this area. And whether it's our carbon trading, whether it's our corporate advisory, asset management, where we're running many of these funds, this plays a very major role. I think it is being noticed by investors. I would not be frank to say that sometimes our reputation, because we built also very strong analytical capacity around the globe, where, for example, on future design of carbon markets, even the Chinese consult us based on our ETS experience in Europe, that the reputation might even suggest that we are already further ahead internally in translating this into practice. So it is a work in progress.
I wanted then to turn from the success stories. In a sense, this is my feeling is this isn't quite getting to the nub of the issue, because we have two companies here, unsurprisingly, been asked to be on the panel who are working in this area and have clear objectives and are able to say we are profitable by doing this or despite doing it, one or the other. Somebody's asked a good question here, which is, can we point to even more examples of where inefficiency has created shareholder value? That actually many companies are driving growth not by being more efficient, but in a sense, not necessarily by being more inefficient, but without paying attention to this. I think, for example, of the extractive sectors, mining and so on, which, as we heard from Jeremy Grantham, is where all the profits are being made at the moment. Is this happening in those sectors, or do we have as many sectors, or if not more, where inefficiency equals shareholder value? Paul?
I think undoubtedly there are. When taking a longer-term perspective, are you using resources efficiently for the long term? I mean, clearly we're not. The world is living on environmental credit card for 4 months of the year, and we're facing what is effectively an environmental credit crunch. We are consuming beyond our means, which, as any American can tell you, is exactly what they've just spent the last 10 years doing. The credit crunch is coming through. But the problem is, of course, that there are still many difficulties in economics in pricing in this inefficiency. I mean, the pricing mechanism is not perfect. It's distorted by regulation. It's distorted by political needs. And so you end up with expansion of companies that are environmentally increasingly inefficient. The whole debate we were having on food this morning, it just points to that you are promoting certain foodstuffs because we must have self-sufficiency in food. I've had discussions with people in UK Parliament about, well, the UK should be self-sufficient in food. Well, why? Why don't we import? Well, because that's not safe. But what you're then doing is developing a domestic agricultural sector that may be going in completely the wrong direction, increasingly inefficient in terms of the allocation of resources, but to serve a political end and to achieve a distorted level of economic growth.
Andy, you wanted to come in on this?
Well, I think one way that we will begin to tackle that is through a better pricing of externalities. And I think what's been really interesting, one of the most positive things from Rio, was the whole discussion on natural capital. And the fact that you had, slightly interestingly anyway, but 3 parallel initiatives essentially doing the same thing. One, the Natural Capital Declaration led by Aviva and many of the finance community, the Cambridge Leadership Compact on Natural Capital, which involved Unilever and SAB Miller and Mars and Nestle and a few others. And then quite a large US-led initiative by the Nature Conservancy called the Natural Value Initiative. And all of them essentially are trying to do a similar thing, which is push a better valuation of the externalities that companies create through their activities, and then second, report on that and price it into the system. And I think we are beginning to see that quite interestingly on the ground in certain markets. So as we do our watershed risk mapping around the world, what we see in South Africa, what we see in Peru, what we saw in Ukraine, was one of the big threats to the clean water supply for food and beverage businesses is mining wastewater. And so how do we begin to see companies start to challenge other sectors perhaps, as they understand the risk they present to them over the long term? Now, companies are not particularly good, and perhaps for a good reason, at calling out their kind of peers in other sectors to change their practice. But I think we'll need to see that, not least because a lot of the civil society pressure recently and around Rio was the fact that it was such a small number of companies, say 150 out of the 1,500 who were there, who were really supporting what they would see as these progressive initiatives, and actually still a large rump, not necessarily being as proactive as they need to.
I think in the end, we have to be honest. I believe very much in pricing externalities, if you get it. But I think in the end, you need minimum standards, you need norms, you need legislation. Look at what happens in the US, where there is no climate, no carbon policy, but a lot is done through very tough regulation of the EPA now. And I think what we have for energy efficiency standards, the Chinese have that big time, and that's well 5-year plan for buildings, vehicle fleets, etc. I think we need that bottom line too.
This is the obvious answer in a way to the wider problem of there are a small number of companies that have made this central to their strategy, but thousands and thousands for every one that isn't doing that. And merely voluntary effort by business doesn't look to many of us going to be sufficient to do this. Welcome though some businesses are. Are you prepared to support minimum standards, regulation, pricing, and so on of resources in such a way that your competitors will effectively be forced to follow your lead? Is business willing to accept that resource efficiency is not something that will simply be voluntarily generated by the whole of the market? Mark?
Well, the one thing that I would say is that when it comes to this topic of resource efficiency, I think that we need to be very careful before we start to try and translate that too much into competitive advantage versus our peers, because there is a commonality to the issue. So all forms of cooperation, I think you made the mention of having different parties around the table, has to be the way to tackle this. But to all of a sudden say, well, I'm more resource efficient than you, as a result I'm a better company than you, and I want that recognition, that can't be the way.
So do you support, as a company, in different markets around the world, do you support the regulatory, the tax, the pricing policies, which will create a level playing field so that your competitors as well as you will be doing this? Is that in general, is that your corporate strategy towards public policy?
But our strategy is much more through cooperation rather than actually with regulation. We are spending much more time, Paul, specifically with governments because of the need. I think that were you to look at the role of the CEO 10 years ago versus today, it's as if you've just added a new part to your business, which is dealing with regulatory authorities and governments and the like. And that's just part of now doing business, so hugely important. Your point, though, is you've invited Unilever, SAB Miller, Coca-Cola. If it is or isn't the real thing, that's sort of neither here nor there. There are so many people that you are not inviting here, or who don't want to, or who aren't showing up. And that's a real issue. And for me, very pragmatically, it starts with tone from the top. And so how can you drive that tone from the top? In the UK, we're driving diversity in boards, be it quotas or not. That's a very emotive topic. But it is being driven, be it through the media, be it through companies, be it through examples and the like. And that has to happen here as well.
Okay, I want to take a question from the floor through the old method. Right. Tell us who you are and your question.
Yes, Ronald Steenblick from the OECD. Before you were talking about reporting through investor reporting or other forms of corporate reporting about your basically efficiency of your organizations. I was wondering what if you could say a few words about some of the, meanwhile, what some of the initiatives going on by governments to try to encourage and in some cases even mandate reporting of carbon footprints, water footprints, environmental footprints in general. I mean, for example, France has now started this on a voluntary basis, and just a couple of years ago was talking about making these kinds of what they called environmental indications mandatory for consumer products. And so I guess my question is addressed to Jean-Marc Huet, since you're a company that produces a lot of products for final consumers, how this kind of requirements for reporting of carbon footprints, water footprints, and so forth are affecting your business model. Thank you.
Let me try and answer that question. It probably won't be successful, and then I perhaps leave it to one of my fellow colleagues who can think longer and harder about it. My challenge right now as CFO at Unilever is identifying the right forum to implement and influence change. It still is, to me, quite baffling that I don't know how to lock in on how to drive behavior in Brussels or elsewhere. And so right now, I'm actually, from a CFO, perhaps not a chairman CEO perspective, I'm thinking about how can you find a lobbying, a forum to drive change. Now that you can actually see quite effectively through the 100 Group here in the UK. You have then the European Roundtable of Industrialists, and they're doing those things. But very specific on certain issues on a European basis, I feel as if I have to create it myself. Sorry to add.
That's what I meant with these alliances of like-minded. That's really an act of leadership where you also give and take. And I think your chairman is doing that extremely well in his initiatives. I think we need to accept responsibility that we come as a group and go to the regulators, go to the policymakers, and also accept some of the cost or the burdens of that. If we do that jointly, we will be heard, also in terms of what we want on the other side, feed-in tariffs, say for supergrid in Europe, from Desert Tech, and so on. But that's the leadership. I think you talked about the different role of CEOs today. That's exactly what leadership means when I say boardrooms have to be ahead of cabinet rooms. But it cuts both ways. I mean, I think we need both, is my answer.
Paul, do you want to come in then, Andy?
I think there is a risk with the regulatory route. Now, the advantage, and there's a very clear advantage as well, is if you're giving consumers more information, actually it helps them make better choices. And the branding of energy efficiency of electrical products is the classic example of this. Here we have the A, B, C, D, and A is the most efficient. They've had to recalibrate the scale because everything was A, which is actually a very, very good development. So from that point of view, that's great, and you're giving the consumers the power. The problem is that as you put on regulations are inflexible because we don't live in a perfect world run by economists. We live in a world run by politicians. Politicians, once they make up their minds, tend not to change them. We've done that, tick the box, move on. And if you've got inflexible regulations, you then start adding a burden which very often comes in as a cost of capital. We're already raising the cost of capital. We're already making it more difficult for companies to invest and develop. And that regulatory burden does run a risk. So regulation, I think, gets a very cautious yes from the macroeconomic perspective. It's fine, but it really needs to be monitored very carefully, I think.
Andy, you wanted to come in?
Well, I mean, mandatory reporting, yes, for certain things, but I wonder if that will become slightly irrelevant by some of the things that are happening with big data and social media and the way that people's products will be labeled in terms of their environmental and social impact in 3 to 5 years if they don't get ahead of it and label it themselves first. So I think we need to look at the broader context. But I also think we need quite a lot from governments, and I completely take your point about how to engage with different levels of government, because particularly on the side around things like, say, water pricing. There are CEOs, Peter Brabeck here, my CEO, Graham Mackay, both been out there publicly saying we need water pricing that reflects water scarcity. Nestle and SAB Miller have big agricultural supply chains, so that will have an impact on cost. Now, of course, it will drive efficiency, so the impact won't probably be as big as it could be. But there are CEOs there making direct calls for things in their supply chain to be more expensive to protect long-term growth. The challenge is government. You know, we have a conversation with governments about how to price water better, and immediately, let's say in certain parts of Africa, for very understandable reasons, it's very politically sensitive. It's perceived as an issue around poverty and poor small farmers in particular. And so we need to find ways, working with politicians that give them the kind of the analytic and insights that businesses have had through the cost curves, through some of the footprinting stuff, to understand why it's important that national policy is set in a way that water policy and agricultural policy and infrastructure policy and energy policy are integrated and not separate. Because one of the biggest challenges for us is dealing with separate policy environments which set goals to 2020 that potentially conflict in terms of the connections between the resources.
Guy, very quickly.
Just the third element in all this. It's government, it's business, but it's also civil society. And whether it's the not-for-profit organizations, we have to, in the era of social media, also engage as business leaders much more in a broader sense to build understanding for water prices or whatever beyond politicians.
The lady here who wants to ask a question, number 3.
Karen Florini, Environmental Defense Fund. You've mentioned, several people here and on prior panels have mentioned strategic alliances between businesses and government and civil society. What do you think are the key elements of the skill set that need to be brought to the table to make those alliances work?
Good point.
Andy, thank you.
From the NGO side, the NGOs that we work with, so particularly WWF and the Nature Conservancy on water, let's say, what they bring already is a much stronger scientific insight into water risk than we have in watersheds and what drives change in watersheds. They often have much better connections to the communities that are often causing damage. So we have a payment for ecosystem services in Colombia, a project in Colombia with the Nature Conservancy for the city of Bogota, where us and a range of other companies invest $1.5 million a year through the Nature Conservancy to pay farmers who were deforesting land to manage it differently, not put their cattle on it, put hedges in there, prevent runoff of soil into the rivers, which was increasing our water price. It saves $4.5 million a year for the city of Bogota in terms of water pricing costs. So it's a no-brainer, but it took a collaboration of the NGO that can work with farmers and the businesses that can engage with the water company to make it work. On the business side, it's not just what we need from NGOs. On the business side, it's quite a challenge, I think, for us to understand the skill set it takes to engage with NGOs and with governments, not just in the corporate affairs department, but more holistically across the business. Because it's not like a CapEx project where you can do a 3-month project, you got your $10 million and you bang it in and your problem is solved. It's a 2 to 3 to 5 year conversation about public infrastructure and how it supports the context in which you want to thrive. Anybody want to come?
Having been both in government and now private sector, but also in the board of many of the non-for-profits, it's a very good question. I think we often even lack the basic capabilities of speaking the same language, acting together. And we need to create, in a sense, non-threatening spaces also where this dialogue, before immediately becomes political or public, can take place. I don't want to mention our specifics, but we have a number of initiatives on clean tech and others, how, for example, Germany can keep its leading role, where we will go for very informal groups of the different companies, the government, others who can come in. European Climate Foundation, we have created for the energy transition in Germany, huge task of getting this right in the next 12 years. Agora, which is basically a space where some of the best talents from business, from society, from politics, come together before the negotiating starts. But it's a very good question because I think many business leaders, frankly, are not all that well equipped to conduct this, understand even through the eyes of politicians how to conduct this dialogue. Training, true leadership, I don't know.
We are coming to the end of the session. I hope that's, for me, it's raised a few of the questions. I'm not sure it's answered them all, but I think that was probably unlikely in the 52 minutes and 23 seconds we had at the beginning. Thank you very much for your questions. I have not been able to answer them all. I have asked them all. I have asked some of them. There was one I didn't, which was, or there are several I didn't, but somebody asked, can we really understand what we're talking about? Efficiency here, is this allocative efficiency, Pareto efficiency, or productive efficiency? And you'll be very pleased to know that that wasn't one of the questions I was going to ask. That clearly came from an economist. You'll know the definition of an economist. It's somebody who's good with figures but doesn't have the charisma to be an accountant. So on behalf of the accountants and the economists on the panel here, thank you very much for listening for this session. I think we're back in about a quarter of an hour for the next one. Thank you. Thank you.